I'm Bill Ty. I'm your moderator for today's panel, The Next Frontier in Payments and Financial Inclusion. I'm delighted to be here in the overall theme of the Milken Institute this year of meeting the moment, because the world is changing rapidly with respect to financial services. We have an incredible panel to bring to the forefront some of the change that's happening. You might wonder why a venture capitalist that started as a semiconductor chip designer is leading this panel. I've been doing kind of tech stuff for 35 years, and I've seen a couple of changes that remind me a lot of what's happening today. If you think back to what happened in the world of computing, we went from mainframes to minis to workstations to PCs, and computing was empowered from a centralized set of structures all the way to the edge, now with smartphones. We saw that happen yet again in communications that used to be dominated by monopoly telcos. And with the creation of the internet, all of that power went right to the edge, and lots of applications came through those pipes. Here we have today big banks in a very consolidated structure. Technology is rapidly invading that space and remaking everything. We have some great panelists, as I mentioned. Aaron Klein is a fellow at the Brookings Institute. He has a great view on regulatory. Neha Narula, she heads the Digital Currency Initiative at MIT and has an incredible perspective, a worldwide perspective on financial inclusion and technology. Matt Harris, he's been doing FinTech longer than almost anybody else I know. I think he's been running FinTech companies for 17 years, so has seen a lot of change and has investments in almost every layer of the stack. And then last but not least, somebody that's feet on the street making that change happen, Grace Wong. She has created her own currency that you can eat. And we'll get into that a little bit more as we talk about what she does. But first, I want to start with Matt, because Matt, you have a great quote that I think you may have borrowed, and you acknowledge that. The race involves whether or not startups can find distribution faster than the incumbents can figure out innovation. Now, we're sitting on a liquid and dynamic set of markets that is always changing, but that theme plays through all of the change you've seen. I'd love for you to just lay out kind of a framework for what you've seen happening over these 15 or 17 years that you've been doing this and where we are now.
Thanks, Bill. And thanks for having me to the Milken Institute folks. It's really a privilege to be here. That quote, which is not mine, but is exceptionally apt as it relates to the last 10 years of FinTech, really the first decade of the FinTech revolution, where we've seen companies scale to enormous size, like Stripe and Chime and Robinhood, N26, Monzo, Revolut, global enterprises created by creating digital versions of existing products. So not truly transformational, in my view, but innovation, how consumers and businesses experience financial services by making historically clunky, analog, in-person experiences digital and often mobile. And that was the last 10 years. And again, tens of billions of dollars in market cap created and market share shifted from incumbents to these new disruptors. But I think that leg is over, because in fact, the incumbents have figured it out. It's actually not impossible to create digital versions of things the incumbents understand well. And so while Lemonade in renters insurance had quite a lead over State Farm, again, it's not impossible for State Farm to figure that out. The JP Morgan banking chase is actually tremendously good. And so while Chime has built a very valuable customer base, I think they have to figure out a next trick. And it's not just digitizing things we understand extremely well. And so our perspective is the next leg of financial services innovation is going to be about embedding financial services in existing software products. So FinTech goes from being a business model unto itself to being an ingredient in other people's business models. This, I think, will be much harder for existing incumbents, existing financial services companies like banks, broker dealers, insurance companies to copy, because it requires technology to be pervasive throughout your organization. You have to, in effect, dematerialize your products and allow software companies to embed them in their services. And just a couple examples there. Many of you may know of the Apple Card. Of course, that's Goldman Sachs on the back end. But what better way to deliver consumer credit than through your phone? Not only an obvious cross-selling channel, but who knows more about you than Apple, whether you like it or not? From an underwriting perspective, it's a nearly perfect place to evaluate who might be interested in an offer of credit and a payment vehicle, and also who would likely qualify. And there are other examples throughout the payments world. Today, fully 10% of retailers take their payments through software. They don't go directly to First Data, Fiserv, or Global Payments. They use their existing software that they run their business to incorporate payments acceptance directly into their workflow. So, Bill, there are legions of examples, some of which we'll get to throughout the program. But fundamentally, the framework now is that FinTech 1.0 is over. We're a digital version of an old thing. Was yesterday's news. And tomorrow's news is FinTech is an ingredient that every technology company should think about incorporating. And every incumbent needs to consider how they face off against a truly distributed world of users of financial services.
You know, this looks, thank you, Matt. This looks almost exactly like what happened at the beginning of the internet, where you had kind of the brands trying to replicate what used to be in the media world, ABC, CBS, and NBC. And there was a theory in the venture community that the world would reduce down to 7 portals. That would be AOL and Netscape and a few others. And that that would be it, kind of like channels on a TV station. But the technology basically broke apart, became packetized, and the services that those brands and other things that evolved could deliver became pervasive. And this is a perfect lead-in for Neha, because she has quite a view on 2 elements that are extensions of what you talked about. One is these technology rails, what can be brought. And a lot of the stuff, Matt, because you're a US-based investor primarily, that was a very US perspective on companies evolving. But we're only a small part of this world. So Neha, tell us what's going on with technology and the rest of the world.
Thank you, Bill. And I love that analogy to the channels because so often when there's a real change in technology paradigm, some people don't see that we can't just replicate what came before on top of new technology. It actually changes entirely what is possible. The internet wasn't just a replication of our televisions. And similarly, when newspapers started to move online, and most of us, I would argue, consume our news online today, it wasn't just a replication of the paper format. That's the equivalent of taking a PDF document and serving it through the web. And it's clear that the technology enables so much more, and that we really have to get creative about the different types of applications that we can build. In my work, I lead the Digital Currency Initiative at MIT. And MIT was really one of the first universities to embrace what was happening in the cryptocurrency and blockchain technology world and say, this is really something different. This is doing for value what the internet did for information. And that's the mission statement of what we do. We want to make it as easy to move value across the world as it is to move information. It's crazy that today I can send an email to someone in Thailand, no problem, SMS them a photo, no problem, but make a small payment, it's outrageous. It takes days. The fees are incredibly high, if I could even do it at all. Our financial system has not kept up with technology, and it's going to take more than just building on top of the old layers. We are building new layers, and those new layers are taking the form of digital currency. So I think we have a lot to learn from the internet. The internet, initially was this great decentralized platform where anyone could join, anyone could put up a website, people could all contribute and find each other. It was very democratized. However, it evolved into this system with a few very, very large platform companies. So even something that started out very decentralized can evolve into something more stagnant. And so really as we're building these new layers for digital money. And we're doing this not only in the cryptocurrency world, but also in collaboration with central banks. We have a research collaboration with the Federal Reserve Bank of Boston to explore building and testing a hypothetical central bank digital currency. So really, we're seeing the rails change in so many different places. And it's this very interesting back and forth between the fiat world and the cryptocurrency world of information. And I think it's going to change the fabric of the financial system. It's going to start to look more like the internet, these layers of open protocols. And of course, we must remember the internet is international. It's not, things are going to change. Value is going to start flowing more internationally. And what I'm really excited about is entrepreneurs across the world are going to be able to take advantage of these new systems and layers.
Well, thank you, Neha, because that's a perfect lead in to one of our other panelists. So Grace Wong out in Australia, an entrepreneur that has basically been building what both of you have talked about. Neha was talking about digital currency. She was talking about value exchange. And, currencies kind of imply the ability to conduct transactions and store value. You also mentioned the Federal Reserve of Boston and the ability to kind of, meter out and monitor a money supply. And in a way, that's what Grace has done with her company, Liven. She's basically turned meals or prepaid meals into digital stores of value that are a token that you can exchange, and you can support your local restaurant, or you could trade them with other people. It's basically, she's like the Federal Reserve for people that want to eat at their favorite restaurant. So Grace, tell us a little bit about, you basically are like a Federal Reserve powering communities of interest. How does the money supply work, and what other things can you do with it? It's more than just a value store. I think it's a little bit of a branding, marketing thing, but it's kind of a unifying communities of interest. So tell us what your customers do with this token.
Yeah, thank you so much, Bill. And then thanks, Milken Institute, for having me. And so much privilege to be talking here from Australia. It's 3 a.m. here, but I'm so excited to share about what's happening in Australia. And so I was a lawyer about 6 years ago, and then now I'm doing this entrepreneurship, and then I'm loving every second. And then what we do here at Liven is we recently introduced the thing called Liven Care Package. And it's as a form of a prepayment for the restaurant's own flavor of closed loop currency. It's underwritten by our network currency called LVN, and it's interoperable between the community currency and then so that in the event that something happens to the restaurant, maybe they close down in COVID, nobody knows what's going to happen. Then the LVN still provides the trust that consumer needs to change their behavior, and then they pre-buy a lot of it. So restaurants provide a various set of rewards or bonuses for each level of financial commitment by the customers, and the Liven application provides a series of parameters that they can use to program their own currency so that it can adapt to and be configured by the users to help it work for their own unique circumstances. Things like I like the time of Mondays, but then I can go to Mondays, but then, if there's a more bonus there, then I'll buy that care package. And then depending on my frequencies and average order value, my strikes, and then combo modifiers. So in a sense, we are moving the decision making and compute from centralized brands to decentralized users to choose and configure how exactly the value should be created and used and moved. So it's a programmable community-based currency that users and also bank-like corporate partners and then Coca-Cola as suppliers can all buy upfront to support their favorite restaurants and their clients and their business clients. So this is a massive step towards financial inclusion on both the merchants and user side. So our journey towards a mass market decentralized finance has led us to empowering all these little mom and pop restaurants instead of investment banks to essentially allow their users to create and buy future contracts against their upcoming dining plans. So this helps operators to lock in not only their future revenue and contribution margin in their customers against from competitors too. So whilst decreasing their reliance on banking and government support and instead empowering their community to step into that role. So in particular, instrumentize unused value and latent demand otherwise being left on the table, but tokenizing that ramen they plan to cook in 6 months' time and selling that to the right buyer isn't something that was ever possible previously, but now it's possible because as a community owned and traded instrument, a peer-to-peer distributed food bank emerges and is universally accessible and embedded in people's social dining life. So these mums and pop shops otherwise didn't have the ability to centralize the trust that the community should have in them and solve their own sovereign currency themselves. Now, independent restaurants, they tried all different things, gift cards and vouchers, and they all failed. But it only works if you are big like a Starbucks. But now with this new model of sharing risk and return and staking benefits, they can crowdsource the tokenization of their own goodwill and brand love. So basically turning every pure transactional customers of theirs into more meaningful and relationship based and more like a stakeholder of the business.
Interesting, Grace. Yeah, because the world has kind of gone, if you read a book, I've read a book by Neil Ferguson, The Ascent of Money, where he talks about value exchange coming from shells and feathers and pebbles, to all the way to modern currencies. And you're basically allowing people to trade meals. I think in the old world, when people crossed from Europe on the boat and stepped on the land at North America and drew lines to define states, whether it was Virginia or New York or whatever, they all started their own currency. So now you can have basically your own currency to store value around the brands that you like in places you eat that you frequent a lot. But and very empowering for consumers, which brings us to Aaron. Aaron, you have been an amazing advocate for consumers your entire life. Through the kind of passing regulatory or helping to drive the passage of things like the Dodd-Frank Act and other things that are very pro-consumer. We've got this technology innovation exploding all around the world now, Australia, US, everywhere else. And it's interesting that you have a white paper that outlines that the US is behind in real-time payments. So one, why is that? Is it going to stay like that? And what are the longer-term implications of the new technologies, the US being behind, maybe catching up or not, in the empowerment of consumers everywhere?
It's a wonderful question, and it fits right into this question of meeting the moment. Our payment system failed the moment, being COVID. When the crisis hit, we tried to get $1,200 to every American family, and it took weeks and months. And in fact, 5 million families who were eligible still haven't gotten their $1,200 that was promised in March. Why? One reason is there is no way for the federal government has made a series of poor choices that have enabled them to be unable to give money directly to people. The same point you can make in terms of businesses, and you've seen some of the struggles we've had in getting money to worthy small businesses quickly to handle this pandemic. Now, let's compare this to the Bank of England, which invested and developed and implemented a real-time payment system in 2008. The Bank of Mexico, 2005, Brazil, 2004, Switzerland, 1998. This is not a question of technology. The technology for real-time payments has existed for quite a long time. What it was a set of poor choices by the operators of the largest clearinghouse of payments in the US and the regulator of the United States payment system, which are the same thing, the Federal Reserve. So put a different way, if you had said, Blockbuster, you're in charge of regulations involving streaming, Anybody think we would be having all these streaming services live to our TV right now? But that's what happened with the Fed. The result has been a shocking transfer of wealth from the 50% of Americans who live paycheck to paycheck to banks, payday lenders, check cashers. Americans pay $35 billion a year by one estimate in bank overdraft fees, in large part because the payments and debits move so slowly. But we have a system that works really well for the wealthy. I think Matt was talking about Apple. So what is Apple doing? Well, first they did Apple Pay, which was a way to get your Apple to just add a little extra slice, 50 basis points, onto a credit card transaction for the convenience of tapping a phone onto a near field as opposed to a card and swipe, which, by the way, is shockingly convenient. I've been stunned how much I've used Apple Pay. I think it's 1% of all transactions at Whole Foods. But all it is putting a higher cost and friction between the merchant and the consumer, targeting higher end consumers. Next, Apple partnered with Goldman Sachs for the Apple Card. Well, yes, the information and data that Apple gets has the ability to generate value for them. It's also a cost play because when you download an app for 99 cents, Apple's highest cost is paying the developer of the app. Its second highest cost is the transaction fee, the swipe fee for using this outdated payment technology. So again, they're trying to reduce costs, not deliver better services to lower income people. And so I think fundamentally, when you take a big step back and you say, wait a second, if the challenge in COVID was let's get $1,200 to everybody, we need three things. One, everybody needs to have an account. Well, the FDIC just came out and said only 5% of Americans don't. So 95% have an account. Two, you need the information. You need to know whose bank account is who. The federal government doesn't know that. So we have a huge data problem. And three, you need a payment system. You need an ability to move your payment from A to B. And the Federal Reserve does not have that. There are private solutions that do. The government had a choice. They could have used the private sector, PayPal, Venmo, the clearinghouse's real-time payment system. Plenty of places can move money faster. But the government in the Treasury Department chose to use the government's other service. In closing, you asked the question, is this going to get any better? I'm a little bit optimistic and pessimistic. I'm optimistic because this issue has risen in prominence. Vice President Biden has made real-time payments part of his platform. There's legislation in Congress to require real-time funds availability. I'm pessimistic in the sense that the Federal Reserve's much anticipated Fed Now program is scheduled to be completed in 2024. And I ask anybody on this stage, if the government promises to have something done in 4 years, when do you think it's really going to be available? I'll close by pointing out that my research indicates that middle income and lower income consumers lose $10 to $20 billion a year due to slow payments. And so if this waits another 5 years, that's another $100 billion out of those families helping to drive the growing wealth gap we face in this country.
That's amazing, Eric. You're spot on about the and we're going to get to some of that because you've got some other papers on those subjects later. But I want to turn to Matt again, because anytime you've got this optimism about the opportunity and the pessimism about it getting filled, that means that there's all kinds of investment opportunities potentially if the regulatory environment's right. And you laid out earlier a great sort of structure to look at kind of where the opportunities have been and where they're going, from first payments to lending and then to investing and then insurance. And as you think about that framework, I'd love to know what do you look at when you are trying to figure out, I want to invest? What are the kinds of things you're looking at as those waves unfold? And are they the same or are they different as you go down that stack from payments to lending to investing to insurance? And where do we put our money? How do we evaluate where we're going to make some money on this opportunity with optimism and pessimism?
Right. Well, the first question we ask is there real pain? Is there a real problem being solved? And, we talked about mobile payments in the United States being slow and us being a laggard relative to the rest of the world. And I would submit it's actually because our payments infrastructure was good enough. If you contrast it with China, where mobile payments adoption has grown by leaps and bounds and is now a majority of all transactions, there was a leapfrog opportunity they had because they didn't have, going back 10 years when Ant Financial was born, as robust and mature infrastructure as we had in the US for accepting cards. And in the absence of that good enough solution, and in the presence of a huge amount of pain on the part of consumers and merchants, they found something truly new and innovative. And so far, we've not found that. I do think COVID is a trigger for that. Contactless payments in the era of a global pandemic all of a sudden go from being a nice to have to being a need to have. And so I'm cautiously optimistic that, one of the silver linings of this horrific pandemic is that the level of urgency around some of this innovation has gone up. And I do think FinTech will be and has been a force for good as it relates to financial inclusion. In ACH, bank transfer payments in the US and how slow they are amounts to, as Aaron was saying, a hugely regressive tax on lower income people who are waiting days for their paychecks, for their government benefits, as mentioned. And FinTech is stepping into that breach. Companies like Chime, like Square's Cash App, like Venmo are providing, if you will, over-the-top rails on top of a messy and slow and latent infrastructure to enable real-time access to funds. And it doesn't stop with just payments transactions. If you think about how payroll works in the United States, you work for a couple weeks earning a bunch of money and you don't get access to that until 3 days after that 2-week period when that ACH hits your bank account or when that paper check hits your mailbox. So you've actually been working at that point for 17 days before you receive $1. And there's a crop of FinTech companies who've emerged to allow you access to those earned wages. You should be able to access at the end of the day, just like an Uber driver can access the tips and fees she's generated that day. Every worker should be allowed to access their earned wages on a real-time or end-of-day basis. And again, there are, at this point, dozens of FinTech companies springing up to solve that gap. So I share the pessimism that government is going to swoop in and solve these problems, but I have real optimism that the opportunity created by that gap is being filled by entrepreneurs. And the problems are being solved by the private sector. Now, they can be expensive solutions in the first instance, but what we've seen in technology-driven competition is that the costs go down over time, often dramatically, often to zero. Now, that's a payment solution, and payments is always the first aspect of financial services to allow for innovation because it is the lowest risk relative, of course, to lending, insurance, and investing, where there's meaningful inherent underwriting required to provide solutions to both businesses and consumers. So payments is not risk-free, but it is surely the safest of the four, and the one where the banks have the lowest market share. At this point, a majority of payments transactions in the US are provided by non-bank vendors like FIS, Fiserv, Global Payments, as well as Square and Stripe, and many of the more recent entrants. And so the fact that you have a technology-driven segment of financial services already dominated by non-banks means that it has been the hotbed for innovation. But lending is coming next. And the fact that lending is now embedded in software allows for a greater pace of innovation. I'll close with just one example, Bill. I don't want to filibuster. Square Capital. Square, you've all heard of. They're a dynamic company that provides payments acceptance services to smaller merchants. And in fact, provides them a full suite of software that allows them to run their business. Square launched a lending product 4 years ago. Small business lending is a risky field of endeavor. You've got to understand these small, fragile companies from the outside in. You've got to market to them, convince them to take your money, and hope they pay it back to you. And Square has none of those problems. In the first instance, they already have these merchants, these retailers as customers. And then in the second instance, they know everything about them. They know their daily revenue to the penny because their software and their payments acceptance service is how those retailers generate revenue in the first place. So their loan book has almost no losses. It actually has zero fraud losses and almost no credit losses, and compares dramatically favorably to any other small business lending company I've ever seen, both banks and technology-driven new entrants. So that to me is the future of lending. It's about a software-enabled relationship with the borrower that lowers risk, lowers cost to acquire the customer, and in doing so creates opportunities for borrowers who've been otherwise shut out of the system.
That's fantastic, Matt, because I think, you and I would not be venture capitalists if we were not optimists fundamentally, but we're always navigating the things in front of us that are risks and trying to reduce them. So we're wired to be pessimistic, to know what it is, but sail through. And, you said FinTech can be a force for good. Actually, Aaron, it looks like Aaron has something he wants to say.
I wanted to jump in on that Square example because they have no losses because it's not a loan. It's a secured advancement of payment. As part of the deal with Square, and I think it's a wonderful product and deep innovation, Square gets 3% of your daily, whatever percent you select based on your loan, of your daily swipe up front. So they have no losses in their creditor queue because they've jumped every other borrower. The business at the end of the day has to decide who to pay, their workers, their other creditors themselves. But Square takes their payment back off the top. And that's that's the great innovation, is jumping the creditor queue. I give them a lot of credit for it. But it really is a different product.
And it's fascinating that it's all really based on data and information about their customers, which brings up another topic that you could get really pessimistic about, which is privacy. So Neha, I know you've got a lot of opinions on that, but here we are where all these businesses and Grace's too, they survive and prosper because they know what the customer is doing or the customer's customer is doing all the time and what their preferences are. We're running into this kind of stuff already with Facebook. What happens when you know everything about a customer and the customer's financial transactions down to the penny, and whether they're a good credit risk or not? Love to hear your view on this, Neha.
Yeah, I think this could be very frightening and dystopian, actually. So if you take an example of countries that are implementing digital currency, the People's Bank of China is piloting China's digital currency right now. They've already had millions of dollars of transactions flowing through their system, and their currency is designed in such a way that essentially the central bank and the government have full information. They can see all users' transactions, they can see how they're occurring, and this is a pretty new data stream for government to have access to, and it's not something I think that would work in the United States, for example. Every country has a different approach to privacy and different standards around privacy. It's very cultural, much like money, and so it's going to be really interesting as this gets more international to see how we manage that. There's been a lot of talk about real-time payments here. And I would argue that that's more of a short-term sort of band-aid. Really, the problem here is that we don't have a platform for innovation in payments and in financial technology. We just don't. Payments, even if a payment goes through Stripe or Square or PayPal, there's still a bank underneath that. There's still a bank holding digital money in digital accounts. And those banks still mediate all of our access to digital money. We don't have unmediated access to that. We don't have unrestricted access to that. And that means that entrepreneurs can't build really and experiment with really interesting applications there. Part of the reason that we have structured things this way is because of our public policy goals around market integrity, around consumer protection, around preventing money laundering and financial terrorism. And so the system that we've structured, to a person, I'm a computer scientist by background, coming to it sort of fresh and not knowing how it works, it looks Byzantine. It looks crazy. We rely on these financial institutions to essentially mediate all of our problems there. They have to file these things called suspicious activity reports, or SARs. And yet, despite the fact that they're filing all of these SARs, it's not really clear that we're actually preventing the money laundering and terrorism that we want to prevent. And it's a lot of this sort of onerous regulation that is increasing the costs and is provided as an argument for why financial organizations have to do so much KYC before they can onboard a customer. And thus, in part, there's a lot of customers who just don't get onboarded because they don't have the information necessary. So 5% of Americans don't have a bank account. That's down. That's great. That's still 14 or 15 million Americans who don't have access to bank accounts. That's still a huge number. And those are probably the ones who need this type of access the most, who need the services that can be provided. So you've got this tension where we're trying to prevent malicious activity, and we've set up all of these systems in order to do that. The systems are actually harming the people at the bottom. If you're wealthy enough, you can get around these systems, and we've seen that time and time again with the leak of the Panama files or with the more recent FinCEN file leak. We see that the wealthy criminals have no problem laundering their money in cooperation with large banks and getting the financial services that they need. So I argue that the system we just need to reconsider the whole thing. And there's really interesting sort of new technological advances that can help us think about how do we keep fine-grained transaction data private while at the same time enabling different types of proofs of compliancy. And this is possible. This is getting to the point where it's possible. It's still a few years out, I would say. But we need to start exploring this, and we need to start thinking about a different type of structure.
Yeah, that's interesting. I think it's about innovation at the edge and the ability for consumers to kind of control their own destiny. And Grace is always talking about her product as innovation at the edge. And in a way, it's an alternative banking system because it's not really money, it's stored value in food. And I'm curious, Grace, do you go through KYC for your customers when they, if I'm going to store value in dim sum meals, do I have to go through KYC? Do the customers care? And what do you guys do to ensure privacy? Do the restaurants care? Do the customers of the restaurants care? How do you handle that?
No, there's no KYC not needed. Restaurants don't really care, and customers don't really care as well. It's just all utility token. And just to go back to talk about what Matt and Neha and Aaron has done, like, I have to respectfully disagree with you guys that we should be pessimistic about this whole thing because of privacy. And then, because while I appreciate the dystopian concerns and the pessimistic lens that you guys have, but I'm an entrepreneur, so I can't help but see the good news in all of this. And because if we dig deeper than at the surface level, then the embedded finance version 1 and the core financial services like insurance and payment and lending and all that is there's more to than that. So embedded finance works best when it's built into the product and at the exact moment it's needed. And where it's needed most is at the very edge of the network where all the rubber hits the road and then value is created and moved. So the beauty of a edge empowered value network for banking is that it lets everyone participate and grow the demand for better and more inclusive financial services. So to what Matt pointed out earlier, like right now, everyone is like basically de facto bank, and then any suitable tech savvy company today has embedded payments. And on the flip side, even non-techie savvy companies can in turn be empowered by offering like a banking-like services and layer on financial products by those enabling tech companies like Liven. And the future I'm painting of here is that the commoditized pervasive embedded finance will be inevitable. But that's why what we have to really need to revisit is how we can fundamentally rewrite where and when and how the value is created and stored and shared to produce higher product market fit, faster growth, and less costs, and service a wider range of consumers, because we really need to go beyond the buzzword of like one button fintech and really understand the implication of this opportunity to prepare ourselves for what's coming up ahead. So when you rethink and rewrite, it doesn't have to be really boring. Like, I'll give you guys a couple of examples. Like, so what Bill was telling me just now, a restaurant scale, not like, say, if you go to a restaurant, and what if you could frictionlessly turn your future ramen into renminbis? And what if you turn your pints into a pounds? Like, better than that, into your own utility token currency that could circulate inside your closed loop economy forever without wastage. So also another truth transformational thing is, what if as a foodie you moved your underutilized saving into your local favorite Mexican joint and score some bonus burrito for your trouble? So that's the kind of world that Liven is actually building here. And we have been evangelizing this since the beginning of the journey. And what gets me really excited is this role about big universal currency, and then the whole ecosystem that we're building. And then in this case, the hospitality world is at the moment is trashed by the COVID world, and they need the technology ever more needed than in the entire history. And now they're realizing how valuable it is to really recognize where their customers are. But it's not that they need to do it like the KYC style, but what they want to know is the fact that whether the customers are the 20%, top 20% of their power users, or the 80% of the users that not really come, and then not really their like power users. All this information they weren't able to know ever before, and now after COVID, they're ever more interested in this. And then Liven is really providing all that through this mechanism, and whilst the privacy is all that covered.
That's fascinating, Grace. I think you're approaching 1 million customers now, I think. Is that right? And I'm guessing that many are banked, some are unbanked, but it sounds like you're providing actually things that sound like banking functions. I can go into a restaurant, eat, and then store up sort of loyalty Liven token points for eating there, and then I can earn a burrito as interest. So it's sort of like everything you'd want to do with a bank. There's probably higher interest rates than the banks in the United States provide. And this brings up a question about what do you do? Because there's so many people that live in the cash economy that are unbanked, and actually in the United States, Neha referred to this too. I forgot the percentage. Neha, was it 14? What was the percentage you said? If it was
large... 5, and Aaron actually brought it up. 5%.
5% of Americans. Yeah, which is a big number. And I think it's not, while it's 5% overall, I think it's like 2.5%. I saw another white paper by Aaron, 2.5% of, kind of white Americans, 14% of Black, 12% of Latino do not have bank accounts. So it's interesting. You could exist and sort of store your value in what you would eat through something like Liven, if Liven were introduced here. But, Aaron, on that point, that paper that highlighted those stats, I'd love to hear you bring up, surface that point. What's it like in America for a lot of the people on this call? We don't live in that world, so we don't really know. And what can we do about it?
So it's really important, and it's become far more important when we have to meet this COVID moment. Because right now, as a result of the virus, cash is infectious and unwanted. In order to exist in a digital world, you have to have access to digital money. I think what Grace is doing is fantastic, not just full of puns and allegories, but the idea of rethinking the concept of money and the mechanisms by which you can move into the digital world. But let's stop and think about, for wealthy people, getting your money digital is simple. It's often lucrative. You get 2% cash back every time you use that Platinum Amex without fees, without taxes, 2% tax-free, really 3% of your money if you have money. But for those folks that don't, 14% of African Americans don't have bank accounts, 12% of Latino households. But here's another statistic, 8% of Americans who have bank accounts spend over $300 a year on overdraft fees. They drive more than 80% of the revenue of overdraft by this 8% of Americans. So there are more American families who spend $300 a year or more on overdrafts than who don't have bank accounts. Banking is expensive. So how do they survive? To answer your question, one, they move into prepaid cards. 1 out of every 10 swipes at a register is a prepaid card. How many of us are using general reloadable prepaid cards? In fact, the Treasury Department started delivering some of these as a way to give benefits, emergency benefits, unemployment, food insurance, and this $1,200 at times, because it was more of an efficient system. What we don't fully appreciate is the fees that go along with that system. Sometimes it's 3% to upload your money. It's $1 every time you check your balance. There's a monthly fee that comes off the top if you don't use this card. 1. 2 is the preposition. So for the number one mobile app for a long time in payments in the US was not Apple Pay, but the Starbucks app. Why? Well, it was a simple economic proposition. You give $50, you upload it once, Starbucks pays 50 cents in swipe fee, then you get 10 coffees. If you did it the other way and you paid $5 a time for 10 coffees, they'd be paying $5 in swipe fee. So they save $4.50 in swipe fee, they kick you back 1 free coffee. A lot of people mistake this as a loyalty play, or Starbucks wants to get your $50 uploaded now, and they're going to earn interest. And yeah, that interest matters a little bit. Loyalty matters a little bit, but really it's a savings of transaction. For those of us who regularly use Starbucks, it's okay to and have a lot of money. I can put $50 in my Starbucks. I can put some money in my Venmo. I can put some money in my PayPal. But for lower income people, if you have to segregate your money today into something that can only be used for food, and on this, I wonder how Grace's thing will work, can only be used for transportation. Say I want to use Uber, right? I have to get an Uber prepaid card in order to do that if I can't link an account there. Prepayment is expensive because now as my income fluctuates, how do I take money out of my Starbucks app in order to use at the grocery store? How do I take money out of my Uber prepaid card to pay my rent? What you end up finding are, for people who are living paycheck to paycheck, the biggest problems are not shocks of expense, but shocks of income. Oh, I lost my side hustle. Oh, you know what? Every year I made $5,000 as a wedding photographer, but not in 2020. I may have even kept my job, but I lost some amount of income. I think there's a statistic going out that 50% of Hispanic households in 3 states poll, Texas, Arizona, New Mexico, reported losing some amount of income as a result of the COVID economy. Not just job losses, but just any form of family income. And those shocks reverberate when you have a thin cushion and put a high penalty on prepaying funds into different categories. And so I think that it's important as we think about the evolution of FinTech to think about it through the lens on both sides of the K-shaped economy that we have. Those who have money and how it impacts them, and those who are living paycheck to paycheck. Because when you go through, you find that second world, the world that Neha is describing, who are getting kicked out of the bank account because it's not profitable to do the KYC analysis on them. But it sure will always be profitable to do it on a wealthy person. How they're experiencing the world is very, very different. And the FinTech solutions that may work for the top half may sound like they work for the bottom, but they don't.
Interesting, this concept of fungibility, because if you've got limited or sporadic income and you've stored your value, you want it to be fungible. And I'd love to get a reaction from Neha, and also because she provides fungibility. And Matt too, is that coming where all these digital currencies can be swapped into the other? And Neha, why don't we start with you?
Yeah, I just wanted to echo a little bit and build on what Aaron was saying. The fact that it's easier for me to make a $50 loan to Starbucks than to just sort of pay for my coffee. Like the fact that Starbucks has to go through all these sort of hoops to try to reduce their swipe fees is a symptom. It's not a positive thing. This is not, oh, great, Starbucks is innovating, there's this cool app. This is a symptom of a problem, which is that we pay too much in swipe fees, that it is too complicated, it is too difficult to make small payments, it's too expensive. And I think a lot of innovation has actually been stifled because of this. And so what we see is we see entrepreneurs like Grace turning to the cryptocurrency world where they can experiment, where they can try things with new tokens, where they can build out new economic models. We're seeing all sorts of new lending products and new payment products being built in the cryptocurrency world. Now, unfortunately, that's not really helping with financial inclusion because that's the digital elite, right? That's people who actually have the time to understand how to use these really innovative cutting edge products and can experiment with them, right? It's not helping that bottom band. The bottom band, as Aaron mentioned, relies on things like cash. Cash is a public good. And if we think about cash is fungible, like you said, Bill, and cash is private. Cash does not require any permission to use. It does not require trusting a bank or potentially having fees yanked out of your account. Cash is simple and understandable. And we do not have the equivalent of digital cash right now. And I think that could be a real game changer. Digital cash built in the right way with the right type of interface and the right features could be really incredible and could enable a whole new layer of financial innovation.
When you talk about your project with the Boston Federal Reserve, are those parameters being considered where, maybe they launch, and I don't know that they themselves can launch as a regional Fed, but, can they produce something like that looks more like cash and less like a stored value?
Yeah, so to be clear, I don't speak for the Boston Fed or any part of the Federal Reserve, and this is research. There has not been a policy decision made one way or another, to the best of my knowledge, about launching digital cash in the United States. However, I will say that in this research that we are conducting, which is mostly around technology, our mandate is to design digital cash, is to think about, we're thinking about the features of cash first, not necessarily the features of bank accounts and our traditional account-based system.
Interesting. And Grace, I'd like to know of your customer base, is it the digital elite, or is there a good percentage that basically started using cash and they just pile up Liven points? Because yours is a fungible system. It doesn't become fungible to Uber rides, but it's fungible across many, many, many different restaurants. Can you someday make it fungible to other things where people look at it like, I'm storing I need to eat, my money's going there, and if I have excess food, I'm going to put it to transportation. Can that happen with your system?
Yes, definitely, Bill, through off-ramp and on-ramps, and that is the part of the vision. And then that is what our white paper it talks about, the whole fungibility and interoperable, not only across the community currency, that the closed loop currency that I've been talking about, that anyone can create, and then they interoperable between them, but also with the network currency, which is the LVN, and then we call it food money, universal food currency, because it's backed by real food. And then that also interval. But to answer Aaron's question about how my vision of the future will work, and then about the Uber currency and then fungible, yes, definitely that is there. And I also agree with Neha that what happened about the Starbucks card thing, that isn't true innovation, and it's not creative with that. It's a fee evasion. So what was pioneered by Starbucks, that initial financial wizardry to shave a few base points here and there and pass it on to evolved and come a long way. But what the true opportunity to use these tools for the power of good is not just for the digital elite, but for the people who need to be included in financially. So in my hospitality world, there's like a massive problem in the loyalty space as well as like the payment space, the contactless payment, and then also contactless tracing, and then all that in the hospitality. But more importantly, there is a significant missing point where the people who create and deliver the value and those who demand and use it are separated by unacceptable latency in today's world. So, for example, how do you price the exact right reward to incentivize a certain behavior for one specific individual's use case out of a million? And it was simply not possible in the current way because uh, the way a brand marketer decides on what reward they wanted to give out before they launch the campaign. But however, Liven is each native application empowers the users to take into consideration their current set of variables like alternatives like opportunity cost, what cuisine they like, what brands they like, what they're hungry for, which friends and family they're nearby them, how long since they've last visited, or what valuation, all that takes into account. So when users solve their own last mile value redistribution, it's more powerful and personalized and timely. So Bill, you were talking about how technological inclusion followed the explosion of edge computing. Likewise, I believe greater financial inclusion is a byproduct of the upcoming explosion of edge value reconfiguration, where everyone can participate. So we've empowered our hospitality nodes to tokenize food into their own currency to create and redistribute that value from their future food margin to where it's most efficiently used. So in this instance, there are many similarities between edge computing and edge value reconfiguration. So like what Neha at the beginning was talking about, we got to learn a lot from what happens from internet. Internet is designed for information moving, but it wasn't designed to move values around. But we are value processing, not just information processing, where the nodes produce and consume values in the hospitality world. So it's like a chunk of stored future economic activity, but the workloads like currency printing, creation, sharing, storage, and use is no longer central, but a closed loop without needing to off-ramp back into the traditional banking world. So that's why interoperability and fungibility in this system is very important. So also another thing is instead of ruggedized devices, our edge nodes are the foodies and the friends and influences and the small businesses. So rather than bringing computation and storage to edge devices, we're bringing value, tokenization, and storage to those people and letting them reassemble it optimally for their unique circumstances. So
That's
this
cool.
is how we overcome that
Let me get
latency
one
issue.
last. Yes, we have 1 minute left, and I want to get a reaction from Aaron because, in the end, regulation matters. And net neutrality in the internet world protected the edge devices, so to speak. How do you think the regulators will react if something like a Liven explodes as an alternative place to store value, earn interest in burritos, and spend it on Uber rides? Like, what happens in that world?
So I think there are a couple things here. Number one, I think the answer is slowly. Regulators have been behind the boat in the United States in a wide variety of things. We talked about real-time payments. You look at China, which was brought up earlier. AliChat and WePay exploded in large part, even in one of the most centrally planned worlds. The banks thought it was just a matter of time before the merchants acquiesced to the fees and put in the card readers. And now you're seeing China leading in central bank digital currency in part I think because the government hadn't quite planned on retail payments leaving the banking sector and going into the tech space. I do think what you find is the threat of what you're describing, best encapsulated by Libra, which I don't think has too much of a applicability in the United States today, but the fear of it driving regulators to try and create a new structure or framework that reinforces the status quo and puts clear boundaries in terms of where acceptable innovation is going to be. But these things, the tipping point, these things happen a lot faster than regulators realize. Per Matt's great point about Square Capital, that has exploded in small business lending, which is a relatively lightly regulated field as it relates to consumer areas. Uber's explosion, similarly, was much, much faster than the regulated taxi cab industry. So I think innovation can end run regulation in this space the way you describe it.
Thank you. Well, it sounds like we are out of time. And I guess on that note, with the theme of meeting the moment and financial inclusion, I'm coming away from this panel with a lot of optimism. Let the regulators leave it alone, and innovators like Grace keep going. Neha, make sure you provide a lot of guidance on what that digital currency, digital cash needs to look like. And Matt, please fund it.
You got it.
Thank you, everybody.
Thank you, everyone.
Thank you.